No. Yes, but I'm going to talk about Monte Carlo simulations in valuation. So as Vasco mentioned, yes, we have a lot more uncertainty in our world today. Already before Donald Trump, that was an issue. He made it even harder to live with this volatility because it's getting higher. We can see that there's a lot of uncertainty in the world right now. And one way of tackling this uncertainty is Monte Carlo simulation, because it helps to visualize how you look at risk. The basic principle is quite easy. You just define a probability distribution, and then you aggregate those distributions to an output. The easiest case of this you can see here. Which is dice. You roll 2 dice, and when you roll them once, you will have an output, which is, for example, the first one here, 9, then 8, then 4, then 7, then 6. But you don't know what the most probable value is of those 2 dice. If you run it 10,000 times, as you can do with Monte Carlo simulation, which today you can do very easily in a few seconds using modern computers, you can see that the most probable value for when you roll those 2 dice, the most probable outcome is 7, as you can see here. The next most probable outcome would be 8, and the next 6, and so on. So now you can understand for those 2 dice how the probability of an outcome looks. What is the most likely result of rolling those 2 dice. And this principle is basically what we apply to company valuation. There are a lot of different distributions. Go to the next slide, please. Here we have a few which are continuous probability distributions. Sorry about the German words. Go to the next slide again. We have some discrete probability distributions. For example, the first one you can see here on the top left is the one for dice. That one would use. But for company valuation, 2 of the most frequent distributions on the next slide are these 2, which we see quite a lot. I think nearly everyone has already heard about the second one, which is the normal distribution, which is used very often in the context of stock market valuation and things like that. And another one that we use quite often in practice is the triangular distribution that you see at the top. This one is very helpful, especially in cases where you have a very high uncertainty and you don't have a lot of historical data that you can use, because this triangular distribution is based on, for example, expert values. Or if you have a company that is very young, for example, a startup company, that you don't have any historic data, so you have to talk to people and understand what are the main drivers of risk behind that startup company. And you might only have a few expert values that you can use. For that, we can use the triangular distribution. So yeah, basically, when we are talking about company valuation, what we need to do first is understand what are the risk drivers of the company. And I'm not talking about every small risk. What we need to evaluate are the big risks. What can happen for a company? What are the main value drivers of the company? And to evaluate those, we have to fit distributions to those risks. To do that, that can be quite easy as for the triangular distribution, where you only have expert values. But as we saw before, there are a lot of different distributions that can be fitted. And if you have, for example, in your company, a lot of historical data, we can use modern software to fit those distributions to your data and evaluate if this distribution is also applicable to the future. So we can use it to understand what the risk in your company is, what the different probability distributions in your company are. Once we have defined those distributions, go to the next slide, please. We can aggregate those distributions. So we take all different distributions that we have seen before, that we have defined before for your company, and the computer puts them all together, calculates it in the different combinations for your company for 10,000 times, 20,000 times. It depends a little bit on the model. This can be done, well, based on the complexity of the model that we are using. It can be done in a few seconds. Sometimes it takes an hour or so if it's very complex. But most of the time, for company valuation, the more simple models are the better ones because, well, we understand the main risk factors very well. We have modeled them out with the distributions, and now we just aggregate them to understand what is the most likely outcome. So for example, here with these two distributions, you can see, for example, that the most likely outcome for the left one would have been 422 million, for example. So this gives you already an overview of what is the most likely value that we get. We'll go more into detail for that in a minute. Can we go to the next slide? To just well, have another look at the main steps that you need to do in forecasting. So as I said, it is very important to identify the main relevant and material risk. That's it, because this way you understand what the main risk drivers for your company are. And you also need to think about what are external factors that influence those material risks of your company. And once you understand those two things, maybe based on historical data, depending on availability, then you have your distribution. And as I said before, you can fit a probability distribution to your past data. And once you have that and know a little bit what the past looked like, then you start talking management, because in your companies, normally you know very well what drives your business, what are the main risks. But very often we see that in management, you know what the main risks are, but quantifying those is something that is quite hard. And that is what applying a Monte Carlo simulation does. It helps you and us to understand what the main risks are in numbers, in figures, so that we can use those figures and numbers to actually calculate the most likely value, so the expected value for the different risks. This is the main wording here. In a DCF valuation, you should always apply an expected value to derive a fair value. And once you have those expected values, you can also know left and right of your distribution what could be a better outcome. So what could be a very good outcome, what could be a very bad outcome. And based on that, you can also take a look at other strategic decisions. For example, if you are thinking about buying a company, knowing those possible distributions can be very, very helpful. If you go to the next slide, please. Yes, here we can see one example of a valuation where, for example, the most likely value was about 291 million. And you can see that this is a very downward skewed curve, where we can see, well, that on the lower end, with a 95% probability, it would have been worth only 162 million, and on the upside, with a 95% probability, this company could have been worth 650 million. So a very large range of values for this company. This is a very large range because this valuation was a startup company that only operated for very few years, and they were looking for new funding. So this the VC fund investing in this company, they said, well, we expect a very likely value, and we have a large upside. And understanding this upside also made it possible for the VC fund, for example, to generate additional purchase price for the owners of the company, because they told them, well, if you perform very well, then we pay you more. And this is also something that can be very easily applied to any other company that is maybe not a startup company, but an established business that you may want to buy. This gives you an overview, what are the likely outcomes. And as a fixed purchase price, for example, you can pay only, well, the most likely value, the one with the highest probability. And for the earn-out for the owners of the company, you can, for example, apply the higher values that are on the upside. And you can also see how high the probability of those values are. So you can more easily talk about how probable this higher outcome for the seller of the company is. So that gives you also an edge in negotiations with companies if you want to buy them. So yeah, this is a very quick overview. I know it always seems a little bit complicated at first, this DCF valuation using Monte Carlo. Just to finish it off, this like looking at risk of the different values is one very good way of looking at Monte Carlo. But what you can also do, and that is very interesting, you can use the values that you generate from Monte Carlo simulation to actually generate a discount factor that is specific to your company if it is private. So you don't need a peer group anymore. You don't need to look at Damodaran and see what risk factors he has calculated. You can actually do it based on the risks that you have defined, that you know normally, and generate a discount factor for your company. And that is something that is also very helpful in Monte Carlo simulation. So far, the overview.